Welcome back to Gimme Some Truth. This is Mitch DeWitt in the booth. It's been a little bit since I've been here. And I also have Evan Waltz in the room. So big welcome to Evan because he has been in the booth, but more in an introductory sort of capacity. Evan is coming up, at the time of the recording at least, he's coming up on a year with Walkner Condon. We've got to be very close. Are we within a week now of?
Very close. I mean, not that I'm keeping track, but I think we're at 11 days until my 1 year anniversary.
Not like you're keeping track?
No.
Okay. And we have kind of a rolling joke about what I'm getting Evan for his 1 year anniversary. And I don't know yet, truth be told. So hopefully performance in those next 11 days trends up, you know. Mm-hmm. No, all jokes aside, Evan's doing a wonderful job. We're happy to have him on his team. But we're also getting more involved in the booth in Gimme Some Truth. So, Evan, do you want to give a quick little intro? Because there's probably some people that have not met you yet at this point in time. I know you've interacted with a bunch of my clients, a bunch of Clinton Nate's clients, but could you give a quick 30-second intro as well?
Yeah, for sure. So as we discussed, I'm coming up on about a year here at Walkner Condon. In my prior life, I spent about 3 years after graduating college working in data analytics at a large bank up in the Twin Cities. Prior to that, I went to school at the University of Wisconsin-Milwaukee for 3.5 years and graduated with degrees in IT management and supply chain management. And prior to that, I grew up in the Milwaukee suburbs. So been in the Midwest all my life, been in Madison for almost 2 years now, and it's been great. Love it. And I live here, shouldn't forget to mention, with my wife, Lauren. We got
Good
married.
Call.
We got married in October. Yes, can't forget about her. We love Madison. Been loving Walkner Condon as well. So really, really happy to be here and excited.
Awesome. We're happy to have you. So should we get into the topic at hand, which is bonds? Bonds sometimes are viewed as the least sexy form of investment. It's always fun to talk about the stock market and, you know, hey, what's this stock doing or that stock doing? Or what's your outlook in the market, right? A lot of people ask that question. What's your outlook? Whether it's over the next year, 2 years, 5 years, et cetera. 9 out of 10 times that question is asked in a way, it seems like, about the stock market. Rarely does someone come up to us and say, hey, what's your bond market outlook, right? But that said, it's an important part of portfolios. It's a way to generate income via bonds, and it's also something that can smooth out the ride in choppy stock market environments. So it's an important part of investing. We still own lots of bonds. A lot of times we own them through exchange-traded funds here at Walkner Condon. But we wanted to talk a little bit about the bond market. So Evan, if I were to say, what is the difference between investing in a bond versus stock? 30,000 foot view.
Yeah, 30,000 foot view. A stock, you're looking at partial ownership in the company that you're investing in. So if I go and buy one share of Apple, I technically own a very small sliver of Apple. Whereas a bond is, whether it's a government bond or a corporate bond, in these examples, is you are loaning either the government or a corporation money in exchange for interest payments over the course of time until that bond matures. So it's two different ways to look at investing, two different types of investments. As you said, they're used for, in your strategy and investing in two different ways. But again, a bond, it's typically viewed as a safer investment. You're generating income, as you said, over time. You're not necessarily looking for capital appreciation like you are in a stock, but you are looking for a safer investment that can generate you solid income over the course of time.
For sure. And they can capitally appreciate or depreciate for that matter, depending on what interest rates do. And we'll probably get to that in a little bit here because bonds do own risk, right? We own stocks to make money. We own bonds to make money. However, how you make money sometimes is different. There's a lot of stocks you can own that don't pay any dividend, right? You're just solely hoping that the price goes up. Bonds, usually you're going to own for the interests that you get along the way, but then also they might also appreciate in value as well. Which brings us to, let's just get into that a little bit right now, actually. It's just the relationship between bonds and interest rates. So there's an inverse relationship. And when interest rates go up, the existing bonds that you own go
down.
Yes. So inverse relationship there. And reason being is if I own a bond that is paying me 3%, let's say, and the macroeconomy largely tracked by just watching what the Fed is doing, but as rates increase and new issues of bonds all of a sudden are paying 4%. And let's say those bonds are equal credit quality, you're expecting to fully get paid that, whether it's 3% or 4% interest, which one would be more attractive?
I would say the 4% interest rate bond would be more attractive than the 3%.
Exactly.
Yes.
All else equal, right? The 4% one is going to be more attractive. So then the 3% bond that I already own is going to depreciate in value because that 4% one is more attractive. So that kind of explains the basic inverse relationship of bonds and interest rates. Were you about to say something there?
Yeah, I think just real quick to touch on, that 3% bond in that scenario, you're not losing any interest payments. You're still getting that 3% over the course of life of the bond, but it's the face value of the bond. Were you to go, sell it, before it matures, that you're going to have to take a discount on that 3% bond, because who would want to buy that 3% bond at face value when they could go buy a 4% bond for the same price?
Exactly. The interest doesn't stop. And that's a good point, right? Because when people invest in bonds, they want that steady income. And sometimes, just because the value of the bond or bond fund depreciates a little bit, so you look on your statement and, it was worth $1,000, now it's worth $950. That doesn't mean that you just press sell. Similar to in the stock market, if your stocks that you own go down, that doesn't mean you just sell, right? Sure, the value might change a little bit, but you are going to be collecting interest along the way. So the last few years have been very interesting in the bond market. And we've got a JP Morgan guide to the markets. We've referenced this on other podcasts in the past because it's really good data and they do a great job of visualizing a lot of different scenarios. So I'm a visual learner, and one place to start is the yield curve, for example. So we're looking at a yield curve chart. This is on their guide to the markets for Q1 of 2025. And the last few years has been interesting. And when I say last few years, we'll go back to 2020. And on this particular chart, it shows what a normal yield curve looks like. So Evan, could you speak to what the shape of a normal yield curve and just talk to the dynamics of what that actually means for a bond investor?
Yeah, so when you're referring to a normal yield curve, we use normal in the sense that if you're looking at the yield curve, you're getting less return on your shorter term fixed income investments and more return on the longer term fixed income investments, meaning that you expect to get more in return for lending your money for a longer period of time.
More risk, more reward.
Yeah,
right?
more risk, more reward. Yep. Exactly. So in a normal yield curve, you'd expect, a 3-month, 1-year, 2-year, 3-year Treasury to yield you less income than if you were to, hand over your money to the U.S. government for 10 years or 20 years. And that's kind of what you'd expect in a normal yield curve situation.
Exactly. And in 2020, this shows that the shape of the yield curve is in fact normal. However, the interest is all very low. So this is just U.S. Treasuries. And even beyond, for a 30-year bond, you're barely over 1% back in 2020. So this is in the era, and this was for years, where interest rates were near zero or low. So the federal funds rate was low. Treasuries weren't paying hardly anything. Back in this time in finance, there was a joke, which I'm going to butcher. I'm not even going to try the joke, but the punchline is essentially something about bonds and it's like a dating scene, right? Like date the bond guy versus date the stock guy, but there wasn't any interest in the bonds, right? Is the punchline. There's no interest in the bonds because they were under 1%. So that was back in 2020. In August, particular 2020 was the 10-year Treasury trough. So at that point in time, the shape is normal, but you just weren't being paid any interest. So a lot of people then were taking more risk in the stock market at that time. In other areas or high yield securities, right, which is a little bit more risk. There might be a risk of not actually getting your interest payment in some high yield type bond offerings. But this is Treasuries. The full faith of the United States government, you're expected to get these interest payments.
Yeah.
All right, so then we look at, and we'll post a clip of this yield curve in the notes. I believe that's possible. I'm looking at Courtney and she's shaking her head and giving thumbs up. So then let's go forward a little bit to, and 2022 isn't on this particular slide, but 2022 was just a brutal year in the bond markets. What was the reason? Well, like I said, in this 2020 era, in 2021, there were very low interest rates, but then inflation spiked. So in inflation, we don't need to get into the inflation story of all the whys, but in 2022, as we know, prices went up. And the response was interest rates go up, right? So back to that inverse relationship of bonds, well, interest rates go up. And not only did they go up, they went up quite aggressively. Bonds tanked. So the bonds that you already own, the values depreciated significantly. The U.S. Aggregate bond market had bond index, I should say, had one of the worst years on record since before Wisconsin was a state, was one of the stats that I always throw out there. All right, so Evan, 2022 happened and rough year in the bond markets. And then let's look at this green line, and if you could describe the shape to the audience who's listening audibly, of course. What does that 2023 yield curve look like?
So the 2023 yield curve that we're looking at here, it looks pretty much exactly the opposite of how we were explaining the normal yield curve. You're looking at the highest yields on short-term treasuries, and as you go along the x-axis, the line shifts significantly down and kind of evens out as you go through 10, 20, and 30-year treasuries, forming what we'd call an inverse yield curve, where, again, you're getting the most money for your short-term investments in the treasuries, and actual less return the more risk you take for lending your money out for longer periods of time.
Exactly. And we're particularly looking at one kind of in the middle of the year in July of 2023, which was the peak inversion, as they call it. So at that point in time, people would say, why on earth would I own a 30-year bond? I'm taking on more risk and I'm not getting paid for it. And we would agree with that, right? So actually during that time, a lot of our clients in their portfolios had short-term and ultra short in a lot of cases. So under a year, under 2 years, under 3 years types of bonds because they were paying more interest and less risk. Now that kind of changed throughout 2023. And then let's just kind of cruise all the way for the sake of time to December 31st, 2024. Where are we at?
Well, we're back to almost more of a normal yield curve. There's still a slight irregularity in the ultra short-term treasuries, but overall, if you look at the yield curve as a whole, we're back to a normal-looking yield curve with 30-year treasuries topping out at about 4.8% right now. Yep,
and it's still relatively flat, right? We're actually getting paid for interest, which is good as bond investors, but you still are kind of looking at it as, okay, that's nice, but I'm not getting paid that much more to take on some more risk. And then you're also forward looking to figure out, what is the Fed doing? What is the economy going to do in 2025? Because if inflation creeps back up and rates start to increase again, well, we talked about what happens in that scenario. So that might not be good for the bonds that you already own. So the yield curve is pretty flat. It's for the most part normally shaped to what Evan was saying, but we're still in this market dynamic of, we're not getting paid that much more for the additional risk that we're taking. But I think a lot of people would look at this period of time in the bond market, and on the Y axis, which we mentioned earlier is the amount of interest. So in all these cases, whether we're talking the 2023, 2024, interest is still up. So compared to that 2020, where the 10-year was at its trough, we're at least still getting some sort of attractive interest for a pretty safe investment. Let's go to another slide here. I've got a couple in mind, but otherwise, was there any of these slides that particularly stood out to you, Evan, that you want to talk about a little bit on this pod?
I think if we skip over to the fixed income market dynamics slide that we were looking at earlier prior to recording this podcast. I think that's got a good. I think that's got kind of paints a good picture, at least in a couple of different scenarios.
Yes. So do you want to speak to this? Maybe just pick. Since we've been talking treasuries, so maybe let's just pick whether it's 10-year or 30-year. Do you want to pick one of those and then speak to the different interest rate scenarios on the right part of the chart there?
Yeah, for sure. So this chart, again, which will be linked in the description of the YouTube video, is looking at your fixed income returns in different interest rate scenarios. So, if interest rates fall by 1%, what happens? If interest rates rise by 1%, what happens? Or if there's no change, what happens? And if we look at the 30-year, specifically, just, for example's sake, today, if there was a 1% rise in interest rates, if you own a 30-year treasury, you're actually looking at it losing over 11% of its value just in a 1% rise in interest rates. So, if the economy, heats back up and inflation kind of goes on the rise a little bit, and the Fed actually ends up, raising rates, who knows what's actually going to happen. But in this scenario, if that happens and you're holding a 30-year U.S. Treasury, just like that, you're losing 11% of your value.
Yeah, and I think throughout a lot of 2024, the market continued to expect rate cuts. Now, the level of aggressiveness in rate cuts were varying, but it seemed to be a foregone conclusion that going into 2025, the Fed would continue to cut rates. However, as we see hotter inflation prints and stronger economic data, people pause a little bit. So even though the Fed might cut rates 0.25%, it might not be what was expected from the market. So therefore, the market gets a little more volatile. So on the flip side, what might happen if rates fall by a percentage point? And let's stick in the 30-year Treasury track here.
Yeah, so if rates, fall by 1 percentage point on that 30-year U.S. Treasury that you're holding in your hand, you're actually looking at almost a 21% increase in value, just like that, in that scenario, which, obviously is a drastic change, versus the 1% rate increase. It's almost a 30-point swing. And
these are very exaggerated because the 30-year Treasury is a long-term bond at 30 years. So you look at the duration of bonds, and that's going to determine how wild these swings are. So with a 30-year Treasury, that's going to see the wildest swings, like Evan said, for 1% fall versus 1% rise, right? You see these big, wild swings in their value. Once you start looking at like a 2-year, 5-year, those swings are going to be a little bit more muted, or the 10-year, right? So those swings are going to come in a little bit and tighten up. One thing that I'll also mention too is some investors use bonds purely as speculation from an interest rate perspective, right? Because if they think that they know what's going to happen with interest rates, then they make that bet on a fall or a rise in interest rates, knowing that something like the 30-year could go up 20%, down 11%. You can actually use these as speculative investments, and those investors are out there. Generally, we don't do that at our firm, right? We know our place for bonds. Are we going to take these into considerations? Of course, we're going to look at what the Fed is doing, what the market expects out of the Feds, and where interest rates go, because that does depend on how we position our portfolios. But we're not going to be the speculative 30-year Treasury interest rate bet investor. So I'll go ahead and say that as well. All right, so we've hit a couple of major slides in the guide to the markets here again. JP Morgan, thank you for that, of course. We've referenced it on past podcasts. It's just a really good way to grasp some concepts that we talk about. Evan, any other thoughts? I know we prepped a little bit before this meeting, but are there other thoughts that we completely missed since I went down a couple other slides here?
No, I mean, honestly, I think we made some, pretty good points. We hit on some important slides in that guide to the market. I think we're in a good spot. Yeah.
So, Evan, great job. Let's a little round of applause for Evan. I'm going to clap into my mic here.
Thank you. It's very kind.
Doesn't mess up Caleb's recording there, but got another thumbs up there. It's always good to get feedback from you guys. So I appreciate that. This is a team effort here. So thank you guys for recording. All right. Thank you all for tuning in to this latest episode of Gimme Some Truth. Bonds, they aren't the sexiest, but they are part of investing. We will see you again next time.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.